Hello everyone, today is the 4th of June 2026. In today's JustDario Daily, we are going to talk about the big narrative shift that is happening in front of everyone's eyes. Not only because the brutal crude oil market math is becoming harder and harder to ignore, but also because at the same time, more and more people are questioning the sustainability of the AI build-up. After years of an incredible run in stock prices of all the companies in the sectors, there are more and more loud talks about a bubble that might have been too big and too unsustainable for much longer. Before we begin, don't forget to like the video, subscribe to my channel, and turn on the notifications if you don't want to miss any of my future updates. Let's begin with an update on the chart I proposed to you for the first time several weeks ago. In this chart, you can observe the oil prices since the beginning of the 2000s and the levels of US strategic petroleum reserves. Yesterday, the EIA reported another monster drawdown. And as explained before, we already know that the drawdowns are going to continue at this incredible pace until a bottom of roughly 280 million barrels in the US strategic petroleum reserves is going to be hit in a few weeks. Why? Because we're calculating the total amount of SPR so far leased by the US commodity traders. And contrary to what everyone thinks, saying that these barrels are just leased and have to be brought back to the SPR in the future at a 20% increased amount paid per barrel, hence these drawdowns are temporary, I want to warn that this assumption of a quick refill of the SPR is nearly completely wrong. Based on the terms of the leases, commodity traders are not expected to bring back SPR into the US cover for years, potentially all the way up to 2030. Here I draw a pattern on the chart, showing not only the first bottom in SPR that we will reach, but I actually expect that afterwards the US is going to continue drawing down the SPR, albeit at a slower pace. Why? Because if they stop completely, considering the current level of inventories overall that I'm going to show you soon, the fact that we're heading into the seasonal part of the year where crude oil demand and demand for diesel and gasoline is the highest, the impact on the oil prices is going to be brutal and significant on the way up. So I expect they will keep trying to do their best to mitigate the worst case scenario. Very soon, traders will have to come to terms with that, because differently from several months ago, when everyone expected the situation to normalize in a few weeks or in a couple of months, we are now over 3 months into the crisis. Even assuming things could go back to normal today, as if they were on the 27th of February, it would require months before the whole supply chain is restored back to normal. No matter what, we're going to see a continuous drop in reserves. And because of the low inventory and demand and supply, the price will be forced to increase. In this next slide, you can observe that the magnitude of the drawdowns with the negative changes across the board for the third week in a row, with total stock of inventories, both commercial and strategic, going down by 17.4 million barrels overall in the US alone. And as you can see in this chart reported by the Financial Times, US oil and petroleum product inventories just hit a 22 years low. Incredibly, oil prices are still trading around $100 per barrel under the assumption that everything is fine, while in reality the complete opposite is happening. Despite this incredible data, let's not forget we still haven't seen an all-time high prices of either oil products like gasoline and diesel at all, despite being in the worst supply shock in history. And if you thought this was only the case for the US, you're wrong, because as you can see, there has been a global coordinated effort among governments trying to reduce as much as possible the impact of their economies from the oil crisis. An impact they wrongly assumed would have been temporary. Japan, despite being a much smaller economy and having lower levels of strategic petroleum reserves, according to the latest available data, has been drawing down crude at an even faster pace than the United States. China, for its part, started doing the same several weeks into the conflict. The reason why the spot market has been relatively calm and all these people pointing towards a collapse of imports, signaling demand destructions, are making a very big mistakes is because imports are collapsing because all major countries have clearly agreed behind closed doors to draw down inventories. But this pace of drawdowns is not sustainable whatsoever. At some point, they will have to come back to the market in order to support their own internal economic infrastructure, and especially they will be forced to start restocking ahead of the winter. Otherwise, there is going to be a brutal economic disaster, even worse than what an oil shock could have even created. Here I want to bring you back to 2020 because we might be going to experience something very similar soon. Remember that in 2020, the market initially reacted negatively to the first news of COVID. But similar to what's happening today, there was a huge effort by all governments, especially the United States, to convince traders that the issue was temporary, not to worry, and so forth. Not different from today. And the market continued rallying for about a month until the whole world fell into lockdown and everything crashed. Today, of course, we're not going to see worldwide lockdowns, thanks God. But the moment other countries will start joining India, which already weeks ago warned its citizens that they have a limited amount of petroleum reserves and will have to start considering measures like limited movements and oil rationing in order to weather the storm, rest assured that will be a moment that markets will not be able to ignore the crisis anymore. And the impact on incredibly inflated stock valuations, especially in the US, similar to 2020, is likely going to be brutal. Don't worry, though. As I said many times, I expect that central banks are going to print a ton of liquidity to reinflate all assets back up, spurring another incredible wave of inflation on top of the one created by higher energy costs. Before that, you need to be careful of the massive drawdowns, especially if you are invested in stocks, especially semiconductor stocks that increased over 100% across the board in barely a month. An euphoria in semiconductor stocks that is coming more and more into question. I just published an article today on a very important topic. You will find a link in the comments on Alphabet's equity raise and whether it is a bold move or a giant mistake. And this follows another important article, whose link you will find in the comments of the video, about NVIDIA now very close to hit the brick wall of circular financing. Of course, the two events are connected to each other because Alphabet tapping the equity market is a clear signal that lenders are very close to being tapped out in financing this monstrous build-up that so far have allowed hundreds of billions of dollars in spending, while revenues still are not showing up and are nowhere close to any business sustainability for the whole sector. This move from Alphabet came at a very bad moment because the narrative now is starting to shift. Uber was the first one to come out and say that going forward they will use AI tools like Cloud Code to manage cost. And this followed the reports that exposed that Microsoft is also having an AI real cost problem, effectively showing how using the tech is more expensive than paying employees. These two headlines actually followed one headline that was ignored a few weeks ago about Starbucks retiring its AI inventory program after just 9 months because of the very high cost and the high level of mistakes and inefficiencies that it created. Here is where I want to conclude today. Next week, new US SPR all-time low will be official, while the full reopening of the Strait of Hormuz is not even on the horizon, despite the non-stop claims from the US administration. Nobody should be shocked if markets soon start to react similarly to how they did in 2020, when it became clear to everyone that COVID-19 would not have just been a temporary problem. It will be wise to start accepting the truth that $150 crude oil prices are pretty much a certainty at this point, and prepare accordingly. In the panic, the price may even overshoot to $200 before real demand destruction comes into play and rebalances the price to its new medium-term equilibrium, especially when we are entering the highest period of crude oil consumption in the year, with all the public capable of affording the current prices of gasoline and diesel, as not preparing whatsoever for the incoming shortages that will result when the first tank bottoms news are going to become mainstream. Critical low commercial and strategic oil inventories cannot be sustained indefinitely, as many still wrongly assume. Restocking of crude oil will come into play shortly after and become a structural tailwind for oil prices in the long term in Q3. This is the reason why the long tail of crude oil futures curve is currently significantly underpriced. Oil companies that so far supported the government's agenda by doing what they could to keep ample downstream product supply in the market on the premise that the whole supply chain would have normalized in a few months since the start of the conflict will be the winners. Governments won't be able to claim price gouging or any sort of behavior detrimental to the public at that stage and fear repercussions like higher taxes or fines. Maybe this was part of the backdoor agreement between them and legislators at the beginning of the Middle East crisis. All those stocks sensitive to energy prices, especially those still trading at asinine valuations like data center companies, will likely suffer the most if the big tectonic shift ahead of us unfolds. Feel free to disagree with all I just said, but like it or not, this is the grim reality, about to spoil the most euphoric mood ever witnessed in the history of financial markets. In my opinion, even beyond the levels reached at the peak of the 1929 bubble. I believe that the markets are very close to a turning point. Today, there were reports that the Korean government is growing concerned about the scale of speculation in its domestic markets. The speculation is driven by massive amount of retail investment, but is also happening at the same time as a significant amount of foreign investors are selling the very same stocks that have risen to incredible heights, especially Samsung and SKX, which are now both over $1 trillion of market capitalization. Be safe out there. Be mindful. This is not the right time to speculate. It is actually the right moment to use the little time we have left to prepare accordingly for what, by now, is pretty much a guaranteed bad correction in markets, after which central banks may resume printing a ton of money via quantitative easing. Although that might not be an assured outcome due to the worst crude oil supply crisis in history. Thanks a lot for listening to my podcast today, for supporting me on X, on Instagram, and for reading my research on JustDario.com. I wish everyone a nice day. Bye.